Hey everyone, thanks for joining in today. Today we're going to go through preparing for the WASDE. Now the WASDE is a very important part that comes out once a month. And what we're going through ourselves and discussing with different growers is we know there's lots of analysts that put different reports out. There's different articles, things you'll read on the internet. And what we're hearing from lots of the growers is getting overloaded with essentially this information, not necessarily knowing what all this information means or how it relates to their commodity prices. So what we're going to do is go through the WASDE, things that we think are worth looking for that we've kind of identified. So how to understand information leading up to and after a WASDE, and using this information to make sure you have a risk management plan that's in place. So a little bit overview of the WASDE. So it stands for the World Agricultural Supply and Demand Estimates. It's released monthly by the USDA for forecasting supply, demand, and prices of key US and global agricultural commodities. It would be considered kind of the premium report that you'll get on anything agricultural production throughout the world, and specifically, obviously being the USDA, it focuses in on the US. So it's widely used by farmers, traders, agribusiness, and policymakers, not just out of the US, but worldwide, just because of its premium level of information and the investment that the USDA puts into this for supplying to the market. The good thing about the WASDE, it's very transparent and it's objective market fundamentals. As I said, it's essentially the premier report. The US has, obviously some high standards, so the information that can be coming out of the WASDE is that much more reliable than, say, some other countries' reports. So things that we want to look at as growers that we think and we've identified as probably being some of the key ones that are easily accessible, public information, and simple Google searches or Twitter searches that you can find to really help you prepare, as well as information that you'll find on the SimpleHedge app as well. So key things that we're going to look for is trade estimates versus the last WASDE, early market movement, so what's happening in the futures, price action, that sort of thing. Option activity, options, what's happening similar to the price action, what's happening with calls, puts, different strategies there. So trade estimates. So what you'll find up leading to the WASDE is analysts will be releasing ranges on trade estimates. It can be private or public. A lot of this information you can find easily through Twitter, as many people are posting up what they're reading and seeing. You can find different articles. And in those trade estimates, it's estimates that'll include yields, acres that equal the production, demand, and carry out. So the estimates will reflect what the market's expectation of the supply versus demand is. So essentially what we have here is indicating how much product is available now and at the end of the crop year. And obviously the USDA being a US report, it is more of a focus on the US, but it does supply or provide lots of information about what's happening in different countries, generally the main ag producing countries or main ag exporting countries. And the USDA does have essentially satellite offices in all those countries that help provide information to these reports. So as we know, a tight supply will mean higher prices, and the higher prices are to encourage farmers to sell for that needed supply for everything that happens in the world. While a loose supply will generally lead to lower prices, since there's less incentive for buyers to be aggressively out there buying, as they have many options. So as you'll see, we'll just use corn as an example. You'll find estimates that'll say 182 to maybe 140 bushels an acre, and their production is estimated at 14.2 to, as we have here, 14.5 billion bushels. So generally it'll be a range because there's obviously lots of analysts and lots of people out there making estimates. The other one is early market movement. So traders and all market participants will be positioning themselves before the WASDE, and they'll be using those positions based off of what their own internal analysis is saying against what the last WASDE was and against what the market is out there saying. So it'll be their own outlooks, their analysis, and they'll be adjusting their strategies accordingly in anticipation of what they think the WASDE will report and how the market is going to be interpreting that. So we want to clarify that the market participants aren't just speculators that are there trading to make money on it. Those obviously exist, but there's actual users of the product and buyers of the commodity. So if a report is expected to be bullish, you can see importers, feeders, crushers, and others will be buying futures contracts to hedge against what that cash purchases they'll have to make. So essentially, they're wanting to buy it lower if it's going to be a bullish report, so then they don't have to pay the higher price. They'll essentially have those purchase futures as a hedge on to offset a higher cash price that they'll have to pay if the report is bullish. Now, on the other, well, I guess with that though, is as you're buying more futures, you're also going to be pushing the price up, particularly if there's not that much sellers or hedgers on it, right? On the other side, if there's bearish reports, you'll have traders tending to sell the futures, pushing the prices down, particularly if there's not enough buyers on the other side. So they'll have to start selling at lower prices to incentivize some sort of buyer to come in. Now, buyers in the market, as we mentioned, importers, feeders, crushes, might often actually hold back in bearish reports. Why? Because they are obviously wanting to buy the futures at a lower price. They don't want to be going up and buying these futures if it drops in price, because then, they're outside and they're going to give up some margin. So as a result, in bearish reports, generally we will see trading volume maybe lower when the report is expected compared to what you would see in a bullish report. So some things that are really easy to look at through the futures that you can identify and start to see maybe which way the market is trending leading up to a WASDE report. The other one is option activity. So options provide key insights into the report's expected volatility. So look at things on which type of options, calls or puts, are having the most activity and at what strike prices where that activity is concentrated. That'll help reveal even more about market sentiment in prices and volatility on those options as well. So implied price movements can be estimated by just adding the cost of at the money call and put options. So essentially you can look at what a call option at the money is and what a put option is, add that together and divide that by the strike price. And that will actually give you insight into what the market is expecting volatility from this report. So if it comes out at say 10%, 11%, the market is saying that they're expecting a 10 to 11% move, but in either direction. So positive or bullish, I should say, or bearish. But the option activity will show you what kind of move that's expected in the WASDE. As I said, it doesn't necessarily mean it's going to be one way or the other, but it's looking that there's expected to be some sort of move there. So you might also see option activity where it's only pricing in maybe a 2 or 3% move. So that means that the market's pretty confident about what they're expecting the WASDE and that the prices are probably already built in and reflecting that. So option activity is a really good one to see leading up to a WASDE where the market thinks there's going to be some expected volatility, or if they're saying, we're very confident in this, we don't expect a massive change from WASDE, that there's going to be low implied price movement there. So we'll just kind of go through a little bit of an example trade scenario for you as farmers that can look back and how you can put this into your own operation and your own risk management plan. So let's just look at corn only. We're only going to assume that the yield is changing, so everything else is going to stay the same. And by that I mean the acres are going to stay the same. We'll say the demand is staying the same, so it's only going to be a yield change. We'll assume the previous WASDE had a corn yield of 186 bushels an acre. So leading up to that, trade estimates, they're coming out with 182 to 184 bushels an acre. So that's a reduction in the yield from the last report. So the market or trade estimates are saying, hey, there should be a bullish report here because all else is equal. So what we'll do is look at early movement. Futures have been trending upwards the past 1 to 2 weeks. That's aligned with the trade estimates. Option activity, we're going to say options are showing about an implied move of 11%, and we're seeing more activity in the call options. So we are seeing that the market's starting to get a little bit more bullish, maybe more strength in what they think is going to happen, but also there could be a surprise given implied movement is at 11%. So, how do we as farmers plan for this? So we want to manage our risk on our commodity prices. As much as it might be nice just to sit back and hope that the prices continue to go up, that's not always the case. And we see surprises in WASDE reports all the time. And it's not just necessarily from this crop year. They might make revisions to previous crop years. And if they start increasing production from the past 2 or 3 years, that just adds to the carry out or the carry in that is going to make things more bearish. So we can't just sit back. We want to look at all these things and prepare ourselves to make sure that we can capture the best prices that we can get for our grains and protect it against any unforeseen changes that may occur. As we know that one price that trades today may never exist, so we need to have a plan in place. So where should we start? Let's start with an assessments. We should assess what we're seeing on trade estimates. What has the market been doing, where that market movement is, and what's happening in the option activity. We also want to look, what is our market outlook? What have we been reading? What have we been hearing about? Not just from one place, but putting it all together. What are we hearing from our local buyers or elevators, crushers? Are they moving their basis up? Are they dropping their basis? Things like that. Are we aligned with the trade, bullish? Are we bearish? Are we sitting neutral? Make a decision there. Then what we really want to do is review. What is our target margin per bushel, or what return on investment are we expecting? Do we want what it currently is at? Are we looking for better? Anything like that. Check your SimpleHedge app. Your SimpleHedge app will provide you what your return on investment is at certain prices and how you can lock that in. Do we have risk appetite or wiggle room to risk a bearish report and lose that margin, right? Where do we have massive margin where we're saying, we can sit back, maybe not do as much, right? That sort of thing, or protect ourselves, further away from where the price is because it's cheaper insurance. Are we bullish and we want to generate income off of this? Are we going to try and average up our inventory value by buying calls or something? Next, we want to act on all this that we've put together. So, what is your margin, your ROI? Are we wanting to protect at current prices? If we are, then we want to enter into a put option at current levels. We want to make sure that that price that there is today, that's got good margin, good ROI, we just want to make sure we protect it in case the report comes out and it's bearish. That put option will help protect us on the value erosion to the downside. If you're comfortable with that slightly lower margin or that bigger risk appetite, you just want to protect on the downside to a certain level, you can buy cheaper put options that would be maybe more out of the money or below current prices. So say corn's trading at $4.40 and you're saying, I can stomach all the way down to 430. Maybe you go buy put options with a strike price at 430. So you are giving up that difference from where the price is today, but you're saying that's kind of the level that you want to protect at. And because that put option might be 5 cents a bushel cheaper than buying what a 440 in the money put option is. And then the other act that you can do then is or buy a call option at the money or slightly higher as a trade, simply to generate income or to average up your forward selling or your inventory. And if you're buying a call option, that means you're taking the bullish stance that you're expecting the prices to go up. And by using a call option, it's cheaper than buying the outright futures and has a little bit less risk than buying outright futures because there's no margin requirement. It's based off of your initial investment. So you can go in and buy a call option as you're hoping that the price will go up and you can generate income just from the financial. Buy a call at one price, let's just say 10 cents a bushel, and you sell it at 15 or 20 cents a bushel. There you made 50 to 100% return on that, or you're using it as that money to associate it to your actual physical to say, yeah, I just made an extra 10, 15 cents in the financials. That averages up my price, and I still have my physical that I can still sell to the local elevator at the higher cash price. So again, all depends on what how you assess yourself, what you wanted to do, and then as you acted on it. So kind of 3 outcomes. What would happen on the WASDE is the yields come in at estimate. So essentially the market was right. The yield was possibly already priced in if that's what was happening leading up to it. So you may see some movement higher just as the report comes out or during that day, and that can be shorts that are getting out of their positions. Remember, just because the market is at a certain yield or expectation doesn't mean that every participant in it is in there. There could be some that were looking still to short and saying, hey, the market was wrong. And if it comes out and the market was right, they have to get out of their shorts, which means they're having to buy it in to get out of that short position. And at that point, they may even flip to a long. So then there's more volume activity that's buying. Your hedge, your put options, they might lose some of their value, but your offset on what that increase on that cash price is going to be, because now your inventory of corn is going to be valued higher because the futures are running higher. So you'll lose some value on your put options, but remember, you are at least with those put options protecting yourselves on the downside. So if the yield comes in lower than estimates, put options become less valuable, but your physical inventory is worth more. Yield is lower, it's a bullish report. So those put options will start to lose more value, but remember, you're looking at it as a financial and physical, where your physical, all your inventory, your actual grain and oil seeds, because of this bullish report, just increased in their cash price. So if you had a call option on that, the call option is becoming worth more and you've generated income or as a trade, or you helped generate more income that you can say averaged up your inventory value. The other one is if a surprise came out and the yield is higher. That is a bearish report. So your put options will increase in value because the futures, the underlying, will start to move down because there's going to be, they're saying there's more supply than what the market previously thought. So people are going to start selling and it's going to start pushing price down. And what a put option does is protects you as the value of the futures go down. So your put option is going to increase in value. You'll have protected against your against what your margin and your return on, and against what your physical is now being valued lower. So it helps offset, again, looking at that financial and physical all as one. In the case if you had done if you were bullish and it came out bearish and you had call options, you're going to lose that value on your call option. Not all of it. You might be able to get out at maybe a little bit of a loss, but you're also losing on your physical value. So it's a bit of almost a double dip. And that's essentially where you can look at it leverage in a way there. So thanks very much. These are just some things that we wanted to go through for farmers to look at it from their own perspective and their operation, not from a trader who's trying to speculate and make all this money, but things that you can do for your own operation leading into these reports that create a lot of volatility, that can create a lot of additional value for all of your grain and oil seeds, or could end up ruining a lot of it and catch operations offhand where now they're stuck at lower prices. So feel free to contact us. We have our US and Canadian number. You can reach any of us here if you have questions about this. Feel free to email me. I'm Steven@simplehedge.com, and of course follow us on Twitter and on Instagram. Thanks very much.